Hey, hi, this is Gautam. So, welcome to this education video series on business valuation. Okay. So, finally, in this module, okay, we are going to value this business, or rather, the equity of this business, the equity of this company. Okay. So, how are we going to do that? We are going to estimate the future free cash flow to equity and then discount it to the present because we have all the ingredients that we need to do that, to do this now. Okay. So very quick recap. So, what we did in module 4, 5, and 6 is we did the hard work of projecting out the revenue cost, that is the income statement. Then we projected out the balance sheet items, and we projected out the cash flow, and then we linked the three statements together. Okay. So, all that hard work we have done already. Okay. And then in module 7A, 7B, 7C, we estimated the cost of equity, that is a discount rate, okay, which we would use to discount the future cash flows to the present. Okay, so in the last three submodules, 7A, 7B, 7C, all this hard work just to estimate one cost of equity number. Okay, all right. And now in this module, finally, we'll be able to conclude the valuation using one method, that is FCFE, free cash flow to equity. Okay, all right. Okay, so let's jump in. Okay, so Kowai, they came with their latest quarterly numbers, that is FY24 Q3 numbers, very recently, yeah, a couple of weeks back. So first, okay, before valuing this business, let's just spend few minutes, okay, in comparing their latest reported numbers. Okay, that is their numbers from the last 9 months, which are out now. Okay, with what we have projected for FY24. Okay, all right. So we are in Feb of of this financial year. So this financial year will be over in 1.5 months. Okay, all right. So they came out with their results, Q3 results recently. So let's compare their 9 months results with what we have projected for this financial year. Okay, and see how far off we are from their reported numbers. And then we'll make some adjustments. Okay, and then after making those adjustments, we'll value this business or the equity of this business. Okay, all right. So, okay, so we'll pull up their latest financials and we'll put them here. Okay, so this would be their 9-month numbers. Here we'll pull their 9-month numbers. So it will be till December. Okay, and here we'll make any adjustments. So first we'll start with the P&L and then we'll do the balance sheet. Okay, and we'll be quick about it. Adjustments meaning increase or decrease, and then the extent of the adjustment here. All right, extent of adjustment or the actual adjustments, all right. Okay, so you go to screener. Okay, you click on the financial results of the quarter ended December. Okay, we've already done that. I've already done that ahead of time. Okay, so let me pull that. I have it here now. Okay, so I have the P&L, the 9 months ended. So let's compare this column, okay, with FY24. So let me highlight FY24. Okay, so you can do this with me and you can track. Just picked up a random color. We'll remove this color later. Okay, all right. So first, let's look at revenue from operations. So if you see revenue from operations, it's 187. I know this is small. Sorry for that. So let me highlight this. So it's 897.5. Okay, that's what this number is. Okay, so let's make a note of it. 897.5. And what is other income? Other income is 15.3 CR. Okay. Okay. So now this is 9-month numbers. So let's first make it quarterly. That is, let's mota at a crude level, very crudely, let's make it quarterly. How do we do that? Divide it by 3 and then annualize it by multiplying by 4. Okay. So if you see, we had estimated 1100 something, and they are almost at 1200. So basically we are $30-40 low. Okay. So we should increase our estimates slightly. Okay. We are not that far off, but very slightly. So it means that they are kind of reporting all at an average 300 CR worth of revenue every quarter at an average crude level without like considering any growth. Obviously, that's not true, but I'm just doing this crude maths here. Okay, so we need to increase our estimates by almost this much. Okay, so we need to increase. And then here again, we need to increase slightly, okay, because our FY24 number is 16, theirs is 20. Okay, so we can increase this a little as well. Okay, so let's just very quickly note down these adjustments. Now let's look at the cost of medicines. That is the COGS. It's 239 point. This is that number, 239.22. 239.3 is, let's just check how much is their COGS against revenue. COGS कितना है revenue की comparison में? तो 27% है. This is not an adjustment per se. This is this is okay. 26.65. Okay. Or by the way, okay, let's first note it down. Okay, 26.65 is their COGS. Okay, this is what it is, COGS percentage. अभी हम compare करेंगे कि हमारा COGS percentage कितना है. Okay, all right. Now let's look at their employee benefit expense and other expenses. So in fact, what we had done is we had kind of lumped all these expenses together, okay, to make our lives easier. Okay, all right. So let's pull those numbers. So this is what their expense is, and ours, what we had estimated is 536.36. Obviously, this is for 9 months. So let's just check कि percentage terms में ये क्या number है. Yeah. So again, dividing by their 9 monthly revenue, this expense, it's around 45 point. So there's SG&A. The percentage is 45.6. Okay. All right. This is what this number is telling us. Now let's very quickly compare their COGS that we had assumed. Okay. So if you see for 2024, our COGS was 27.7. So it's very close. Okay. In fact, our COGS is higher, their COGS is lower. In fact, perhaps they have been a little more profitable than we expected. Okay, at least in the first 9 months. So their COGS is 26.65. Okay, so we'll make that adjustment. Okay, and then their SG&A is 45.56, ours is 45.9. So it's very close. And again, they are lower. So again, as I said, they are a little more profitable than we expected, but just a little bit more. Okay, not a huge difference. Okay. So we'll make these adjustments. Okay. So we'll reduce our cost. In fact, let's equate. These are just notes to myself. So I'll equate. I'll replace our assumed COGS percentage with this. I'll replace our assumed SG&A percentage with this. Okay, so that's what I'm going to do. Okay, and then finance cost, let's quickly note it down. Finance cost or interest cost is 26.1, 26.05. Okay, let's analyze it. Okay, all right, I'm just checking. Yeah, all right, that's fine. So they may have perhaps, they may have reduced debt. That's why they're perhaps their finance cost and annual finance cost is lower than what we have, but we'll look at this when we get to the balance sheet, because we need to obviously check if they have reduced debt or whether they are at the same debt. Okay, because obviously finance cost is dependent upon what debt as well. So let's check tax as well. 43.1. 43.1. Okay, that, let me just compute the percentage. What is the profit before tax? What is the profit before tax? It's 170.65. Okay. So let me just compute the tax rate. It's 25. So it's pretty close, man. All right. So let's not break our head into tax rate and all. I'm not going to worry about this. No, I'm not going to do any adjustments here. It's pretty close. Okay. Let's just straight jump to profit after tax. So profit after tax is 128.01 for 9 months. Okay. So it's 128.01. Let's analyze it. So it's 170 if we analyze this. Okay. All right. So our profitability is lower. Okay. It's all, yeah. So this would be taken care of by itself when we make these adjustments. All right. Okay. All right. And obviously we'll make adjustments to finance cost and depreciation once we get to the balance sheet. So first let's make these adjustments. Okay. These cost adjustments, and then we'll make the revenue adjustments. Okay. So let's go to financial ratio. Okay. Let me copy this and let me paste it here. Sorry. COGS. And then this is SG&A. Okay. All right. So this adjustment has been done. Now let me remove this. Let me just mark this as done. Otherwise I'll forget. It's always a good practice to do that. That's why I'm showing you all these steps. Okay, so basically this is done. Okay. Now the only thing that we need to do is, the only adjustments that we need to make is, and again, let me just remove this tax because we're not going to do any of this. So the only adjustment that we need to make here, at least in the P&L section, is increase revenue slightly and increase other income. Okay. So other income, let's increase 20.4. And it's always good practice because this is a hard code. Let's change the color of the text. Let's make it blue color. Okay. All right. And now let me remove this color as well, overall color. Okay. All right. Okay. Now okay, so this is done as well. Where did it go? Yeah. All right. So the only adjustment that's left is increasing revenue. So let's go to operational ratios, because that's where we had estimated the revenue drivers. Okay. All right. See, we could always get into कि कितना healthcare में report किया है, कितना education is. Education is 63 CR. We are at, sorry, education is 63 CR for the 9 months. We are at 84. So I think it's pretty close. If they analyze this number, it would be pretty close. So okay. So I think this is fine. So I'm not going to touch medical college revenue. I think we are good. The slight adjustment we need to make is we need to increase our inpatient and outpatient revenue slightly by around 30 CR or something. Okay. So if I make this, say, let's say 2000. And how did we, by the way, project inpatient revenue? It's a function of operational beds occupancy, and average revenue per operating bed. Okay, so let's increase the operational beds to 2,000. And let me, since I did this hard code, let me change the color to blue so that I don't lose sight of it. Okay, all right. And let me check key. Okay, so see the difference was around 30 CR, 28 something. Now it has reduced to 9. So let me increase it slightly, little bit more. So we kind of bridge this gap further. ठीक है, ताकि हम और क्लोज आ जाए. Okay, so let me increase. Okay, so perhaps we can increase this average revenue per operating bed little bit slightly. Okay, so we have assumed it's growing by 4%. Okay, so let's increase it slightly. Okay, so again we made an adjustment here. Let me put a color. Key, this is what we had changed. Okay, let me see key there is any. All right, so it reduced from 30 to 28, 29 CR tha pehle. From that, it reduced to 5. So we are pretty close. Okay. So I think that's fine. I don't want to like make any, like sweat the small stuff. I don't want to like solve for 5 CR worth of difference. Okay. Anyways, these are just an approximation. All right. Okay. So we are done with our P&L adjustments. Okay. I know we have not adjusted for finance costs and depreciation yet because that is dependent upon balance sheet. Balance sheet mein kitna debt, how much debt is there, and also how much gross fixed assets they have. All right. So now let's go to the balance sheet. Okay. And make the adjustments. Okay. So again, we are going to compare FY24 numbers. So let me just put it in a different color. And again, see in balance sheet, there are 3 things that we look at. One, as I said, the gross fixed assets. Then debt, obviously, it's very important. We look at debt. Okay. Key if they've paid down debt at all. And the other thing is, we'll also look at working capital. Okay. See, Kowai did not release the latest balance sheet in their Q3 numbers that they came out with. However, they did release the balance sheet in the Q2 earning release. Okay, so Q2, that is numbers as of September. That is 6 months is what we have. Okay, so let's just go ahead with that. Okay, so I have that pulled up. Okay, all right. So let's look at the first item, PPE. PPE is 1042 CR. Okay. And then right of assets is 30 CR and capital work in progress is 40 some CR. So it's 70. So all these three items combined, the first 3, okay, it's very close to what we have here. It's very close to this number. Let me just make sure I'm getting recorded. Yes, yeah. Because see, we had lumped those 3 items together in this one. So it's very close. So I think we are good here. Okay. Let's move forward. Intangibles, again, it's 1.06 CR. Okay. It's very close to what we have. So that's fine. Any which way, it's a small number. So not worried about that. Investments, again, it's too small a number. So let's not worry. Other financial assets is 17 CR. And other financial assets that we have is 27 CR. And again, this is 6 months and ours is 27.5. So which is fine, right? Because ours is like fully a number. And then other non-current assets is 31.78 CR, this number here. Okay. And ours is pretty low. So we may have to do some adjustments here. So 31 point. So this number is 31.78. Okay. And yeah, all right. So we may have to increase this a little bit. Okay. All right. Now let's move forward. Let's quickly check working capital item like inventory. Inventory is 15 CR. and ours is 16, so it's pretty close. Let's not worry. Receivable is 25 CR. Receivable us is 32 CR. So I think this is fine. Okay. Cash in bank equivalents is 41 CR plus 139 CR. So it's around 180 CR cash. Ours is pretty high. So our cash is pretty high. I might suspect that is because they may have paid down debt with cash that we'll see. So their cash is what, around 180, right? So let me just write this rough number. So what it means is that we'll have to reduce our cash. Yeah. So our cash is high by 233. So we'll have to reduce by this much. We should ideally be reducing it. But again, that is 6-month ka number. This is like 12-month ka number. See, but what it is telling me that we'll have to adjust our debt. We may not have to make any explicit adjustment to cash, because cash for us is obviously gets auto calculated from the cash flow statement. So we wouldn't have to worry. We'll have to worry about debt. Okay. And that should take care of this cash. Okay. So again, other FA, some other working capital items, very small. Okay. Not too worried about them. So it's other financial assets is 8.7 CR. Ours is 6.65. So that's fine. Other current assets is 9 CR. Okay. This is fine. All right. Let me just move past it. Move past and let me check debt. Okay. So our total debt is 511 CR. Okay. Now let me check. Okay. Their debt is, and by the way, in debt, we have lumped 3 numbers. We have so it's long-term loan plus short-term loan plus liability. So we have lumped these 3 things together in this debt. Okay. Right. So there, let's note it down. This is important. 3, because we got to use this. 333.67. Okay. That's their long-term loan plus lease liability 34.67. I'm referring to these numbers. Let me highlight this. See, this is too small. Okay. So yeah, and then 34.67. So let me add this here. Yeah. And then yeah, let's look at borrowings. Short-term borrowings 20.98. So let's write 20 plus 21. Okay. And then lease liability is 2.42. So yeah, 2.4. Yeah. See, so this is their debt. What we have taken is 510. This is annual, and what they are saying as of 6 months is 391. So they have reduced their debt. That means, okay, how much they have reduced it by? That is, our debt is higher, so we'll have to reduce debt by this number, 119 CR. Okay, we'll have to reduce by debt by 120 CR almost. Okay, because, and that explains the difference in this cash. Okay, doesn't explain it to the precisely, but it does explain कि they have used, it does tells us that इन्होंने cash use किया है, sorry, debt cash use किया है to pay down the debt. Okay, right? So this number we'll use. Okay, now let's take a look at some of the other items. See, equity, we don't have to worry. Equity, their equity is 781. Yeah, 781, and ours is 870. That's fine, because again, like cash, equity gets auto calculated. Your profit gets added to equity. Okay. So that will be taken care of. If we make these other adjustments, the equity and cash will be taken care of. Deferred tax. Okay, let's look at some of the other item provisions to smaller number. Yeah, that's fine. It's 20.85. Ours is 18. That's fine. All right. I think I get a sense that all the other numbers look fine. So I don't want to like waste a lot of time just comparing each and everything. Payables is, yeah, I think it's 90. Okay, let me check payables. Just 1 second. So payables is 20, 30. Yeah, it's around 30. So ours is 30 as well. So this is fine. Let's look at other financial liabilities. So their other financial liabilities 87 is 87 and ours is 60. All right. So ours, we are understating. We are understating our other financial liabilities. Okay. So we need to reduce our financial liabilities by, we need to increase our financial liabilities by 27 CR. Okay. Now let's take a look at other current liabilities. It's 43. And our current liabilities is 84. So, our current liability is pretty high. So we overestimated here. Okay. So reduce. Okay, we'll reduce it. Reduce by how much? So around 40 CR we'll reduce. Okay. It's okay. All right. Okay. I think besides that, I think we are good. Okay. We just need to make that debt adjustment, and then we need to make these two adjustments. So let's do that real quick. Okay. All right. So other financial liabilities, because here in the inventory side, I think we are okay. Inventory and receivable side, we are okay. So current asset side, we are okay. Liability side, one item we underestimate, one item we overestimated. Okay. All right. So let's just make those adjustments real quick. All right. So current liabilities, how we're estimating it, J29. Let me go there. Okay. Here. Yeah. So what do we need to do? All right. So yeah, we need to increase. We are understating. We need to increase it. Okay. So we need to increase this number to around 87. So let's do that. So you know what? Let's take the average. So right now we've just taken the last year ka number. So let's take the average of days of financial liabilities outstanding. Okay, because the past looks higher. This number looks higher. Okay. So if we take this into account, okay, yeah, see earlier what we were doing is we were using this latest number to estimate our other financial liabilities. But then what we did is we took the past 6-year average. Okay, in the past, the financial liabilities were higher. Okay, so when we took the long-term average, so our number also shot up, and it's very close to what was reported. Okay, in the latest balance sheet. So we are good here. So let's strike this off that this is done. Okay. And you see the balance sheet is balanced. Always got to check the balance sheet should balance. The balance sheet has balance. Okay. So that means our linkages are just fine. Okay. Now we need to reduce the current liabilities by around 40. Okay. And this is I-32. So let's go to I-32. So we need to reduce it. Same story here. Okay. We've taken the latest number, latest days of CL outstanding to estimate the current liabilities. Okay. But if you go back in time, the current liabilities were lower. Other current liabilities, were lower. So let's take the long-term average. So the long-term average would be lower. And let's use the lower long-term average to estimate the other current liabilities. All right. So see, they have dropped. Okay. Now let's go to the balance sheet. Okay, it needs to be reduced further. Okay. So let's reduce it. In fact, you know what? Let me make it 15. And let me. So I've done this hard code. Yeah. Okay. So that's why I changed the color to blue. Now let me go back to balance sheet. I think this is fine. Okay. So it reduced the gap. Okay. All right. So I think this is fine as well. You don't have to be super precise, because any which ways is like we are using Q2 ka balance sheet. Okay. All right. Okay. So I think, and the balance sheet remains balanced. So I think we are good here. All right, so now the only item that's left for us to adjust is debt, and that's key. We got to reduce the debt by 119 because they have been paring down debt. Okay, so let's go to the cash flow statement. Okay, in the cash flow statement, okay, let's write minus 119 point whatever what that number was. Let me just take a look again. Sorry, let me 119.17. All right, okay, let's use this number. Minus 119.17. Okay, all right. So if you see now, if you go to the balance sheet, okay, so we are exactly the total debt on our books is exactly what they reported in their Q2 numbers. Now we do not know कि how much की Q3 में कितना reduce किया, but that's fine. At least we are in sync. This is a key item. We are in sync with what they have on their books as of Q2. Okay, all right. All right. And let's make sure the balance sheet again, see it's balanced. All right. Okay. Now we've done all this hard work. Now let's get to estimating free cash flows and value this equity. Okay. So I just open FCFE. Let me paste text from here. Okay. I don't need 2018 to 23 columns. Let me hide it. How do I? Yeah, hide. Okay. All right. Now let me just start. So first, the thing is we need profit after tax or net profit. This is what we need. By the way, you guys remember, right? How we calculate free cash flow to equity? I'm hoping you do. Otherwise, let me show you very quickly. So let me refresh your memory real quick what free cash flow to equity is. If you remember, okay, free cash flow to equity, how you estimate is you start with profit after tax, so net profit. From that, you net out capex, the net capex. You net out change in working capital, then and you add total net debt issuances. Okay, that's how you estimate free cash flow to equity. Okay, that's what we're going to do. And once you have done that, okay, 5 years out, then we got to discount each of those future free cash flows by the discount rate, the cost of equity, that is R, that we estimated in the last three modules. So that is what we are going to do. Okay, so once we estimate FCFE, we are going to discount it to the present. Okay, and then also estimate terminal value discounted to the present as well. And that's how we are going to arrive at fair market value of equity. Okay, so if you want to like refresh your memory, please go to this module. Okay, now let me go back here. Okay, all right. So start with net profit, then less X, add back depreciation, less. So, and we have everything. It's just now a matter of plug and play. Let me remove my pretty photo to the right. Okay, change in working capital. Okay, and then also add debt issuances. Okay, this is what we need to do. Let me move it to the right. Okay. Now everything is pretty straightforward because we have everything that we need. In fact, the bulk of the work in valuation was modules 4, 5, 6. Yeah, the projecting out P&L, balance sheet, cash flow. That was bulk of the work, man. Okay. All right. So net profit, yeah, you could either go to P&L or let's go to cash flow. Let's go to cash flow. Okay. This is your net income, right? 168. So let's drag it. Let's pull it forward. Okay. Similarly for capex. Okay. Again, you can go to the balance sheet, but let's go to cash flow. You have the cash flow is, yeah, we need this sign minus 100 because, yeah, that's fine. So 100. All right, let's drag it. Depreciation. Again, we can go to the cash flow. Again, you can pull it from the P&L if you want, but I'm just going to go to cash flow. This is the depreciation amortization, which will get added back. Let's pull it forward. Okay. And then change in, less change in working capital. Again, so it's just a matter of plug and play. Change in working capital. So we have that as well. So let's, from the cash flow statement, change in working capital. So let's pull that. Let's drag it. Okay. Net debt issuances. Again, go to cash flow. We have this. So it would be this net total debt issued plus total debt repaid. Okay. These two items combined. Okay. So now we are assuming कि कोई इस साल डेट थोड़ी कम कर दी और वो डेट उतनी ही रह रही है बैलेंस शीट में फॉर द फ्यूचर ईयर्स. Okay. That's a simplistic assumption. Obviously, it may not be true. Okay. All right. As I said, we'll change the debt number. So let me drag this. It's 0 because, as I said, we have not assumed any debt issuances. Neither we have assumed any further paring down of debt for now. All right. So now we have done this. So what's the free cash flow? By the way, there is a terminal year value, terminal value. So free cash flow equity is sum of all. We already have the signs prefixed, so it's sum of all. Let's drag this. Okay. All right. And by the way, one thing more, I should have been a little upfront about it. Okay. Either assume 1 decimal or assume 2 decimal places. Let's just go with 1 decimal for all. Okay, except percentages, certain percentages you may have to report in 2 decimals, but let's just go with the convention of 1 decimal place for all. Okay. All right. So we have this as well. So we have estimated the free cash flow to equity. Right. So now we need to discount these free cash flows by cost of equity. So let's pull cost of equity. Okay. Cost of equity is 10.39. Okay. And also we need to estimate a terminal value as well. Okay. All right. And how do we do that? Okay. So we need to make a terminal growth assumption that beyond 5 years, our free cash flow to equity would continue to grow at a certain rate in perpetuity. Okay. So let's assume that beyond 5 years, they would grow at the risk-free rate. And let's document this assumption. Okay. So let's pull the risk-free rate here. 0.66. All right. Okay. Now let's estimate the terminal value using the Gordon growth model or the Gordon growth formula. Okay. And the Gordon growth formula really is you take the last year's cash flow, you have to increase it by this growth rate and then divide it by cost of equity minus terminal growth. This is the Gordon growth formula. In the denominator, okay, you from cost, you take cost of equity, okay, and then from that you net out the terminal growth. Okay. So this terminal value 5,075 CR. Okay. This is so how do you interpret this? Is that, see, with Gordon growth, with this formula, you don't have to project out your free cash flows for each and every year, in perpetuity. Okay. Because we have this formula, so that's why it saves us from having to do that. Okay. So this 5,000 CR something, okay, this is the overall free cash flow that this business would generate in all the future years. So that's what this 5,000 really tells us. Okay. All right. Now what we need to do is, okay, we need to take the present value of all these free cash flows, including the terminal value as well. This terminal value is also kind of a cumulated free cash for all the future years. Okay, so that's also free cash flow. It's just it's cumulated. All right, so okay, for present value, I'll have to do this. Okay, so you take free cash flow divided by, it is this discounting now, divide by 1 plus cost of equity, then caret. Sorry, we don't have to discount this free cash flow. You have to discount 2025 free cash flow. So you take this free cash flow, divide by 1 plus cost of equity, and then caret 1. That's how you discount, right? Okay. I explained it in module 7A and also in the introduction to valuation. Okay. All right. So what this is telling us is that 182 CR next year is worth 165 today. That's what this is telling us. Okay. So let's lock the discounting and drag it. Okay. Please keep in mind the terminal value when you discount it. Okay. Right. So you use, the compounding should be, the year should be 5. Okay. If your forecast period is 10, okay. All right. So in your discounting, so I said compounding, sorry. So in your discounting, okay, here it should be 10. Okay. You don't take 6 or 11. Don't do that. In fact, that's a lot of interviewers, they ask this question, that how do you discount your terminal value? Okay. Do you use like forecast period plus 1, or do you use just a forecast period to discount? Okay. All right. Okay. Now, so what's the sum of our, what's the sum of our present value? $3,944. What do you think this is? The sum of present value, this is fair value of equity for this business. Okay, this is what this is. Okay. All right. So fair value of equity is this number. We did all this exercise until now to just arrive at that number. Okay. How many number of shares they have? You see that I have not specified units anywhere. Okay, because I've made that call out here up top. Okay, but now we're not talking about rupees, currency, number of shares. So I've just added this here. So it's very clear. Okay. Number of shares, let's pull. It's 1.09, right? It's getting recorded, right? Just making sure. Yeah. All right. So let's try that here. So what's the fair value per share or intrinsic value per share? It's fair value of equity in CR divided by number of shares in CR. Okay. So this is what the fair value per share is. Let's see how much this is trading at. The share price right now is trading at 3,800. So we are, okay, it's just slightly overvalued based on our estimates. Okay. So the business is 4,100 something. Okay. Our free, as per our estimates, the value of equity for this business is almost 4,000. Okay. So basically it's very reasonably valued right now. Perhaps just slightly overvalued as per our estimates. I would say it's reasonably valued. Okay. All right. So let's write current market price. Current market price is what? How much was it? 3805. 3805. What does it tell us? So let me current market price. So what's the difference? So the current market price is trading at a premium of 186.5 over our fair market value. All right. So it's trading at a 5% premium. Yeah, it's basically it's trading very reasonably right now as per our estimates. Yeah. Yeah. See, we have done this. Now let's also estimate the enterprise value as well. Okay. How do you estimate the enterprise value? Fair enterprise value. How do you estimate that? So here's what you need to do. In your so let's in your free fair value of equity, you need to add debt and reduce cash. The free value of equity is this. Okay. Let's pull the debt from the balance sheet. Debt is 391.74 as of today. Okay. And how much is cash? I prefix the minus sign because we need to take this off. Net this out. How much cash do they have? And yeah, by the way, the balance sheet, balance sheet is balanced. So we are good. So cash is 291.75. Right? So what's the enterprise value? Fair value of equity at cash add debt less cash. So fair enterprise value is 4,044 CR. All right. And by the way, I should fair market value, I should write in rupees because this is not in CR. All right. Okay. Now, okay. Let's do something. Let's change our debt assumptions for the future years and see how it changes our enterprise value, our equity value. Okay. So if you see, debt stays the same right now. Okay. And cash keeps on getting accumulated from around 300 CR now, as of this year, okay, to 1400 CR. See, ideally, they would be earning, if this were to happen, they would be actually earning interest on this number, okay, and making a higher profit. But we haven't modeled the interest that they would be making. We haven't modeled that. Okay. Because ideally, what would happen is they would pay down their debt, or perhaps they may do expand capacity. Okay. So let's pay down debt. Okay. Still, they would be left with a lot of cash, actually. Okay. So let's do that. Let's go to cash flow. I'll assume that again next year they reduce 100. They paid their debt down by 100 CR. उधारी कम की 100 crore से. Next year, 50 CR they used to reduce their debt. Next year again they use say 50 CR to reduce their debt. Next year again they reduce say 50 CR to reduce their debt. Okay. Now let's see how much cash they have. So if they keep on doing that, okay, their debt reduces from 400, almost 400 today, to less than 100. Okay, 5 years out. Okay, and the cash reduces from almost 300 CR to 1150 something. Still, they have a lot of cash. Okay, let's see what it does to our valuation. By the way, let me see if the balance sheet is balanced. Yes, it is. So we are good here. Let's go to FCFE. Okay. What happened? The free cash flow to equity, okay, this reduced. Why do you think that happened? See, because obviously, if they're using debt, if they're using their free cash to, or the free cash that they're generating to reduce debt, the free cash flows are going to come down, right? Okay. उधारी चुका ली तो फ्री कैश शेयर होल्डर को देने के लिए कम बचा, तो फ्री कैश कम हो गया. Okay. All right. That's why the value of equity also has reduced. Okay. And now the premium earlier was 5%, was very reasonably valued. Premium of 5% is like, I don't consider it as a premium at all. it's reasonably valued. Okay. So now the premium is as high as 18%. Now it looks, now the share looks overvalued. So what you should do now? See, if you really believe this business to be mature, stable business, then ideally, logically speaking, this business should reduce their debt over time. If they don't do that, then the interest outgo on this debt would be higher than the interest that they make on the cash that they accumulate over time. So the logical thing to do would be reduce your debt, udhari kam karo. And that's the assumption we're going to go ahead with. Okay. So always, it's my advice, just think logically. If you're feeling stuck, DCF is all about, valuation is all about making reasonable assumptions. Okay. And then obviously documenting them as well. So that's the assumption that we have made. Assumed debt reduction over time. And write your reasoning why as well. Why you have assumed so. Because you have assumed that this is a stable growth business and this is the logical thing that they would do. Okay. And then let's, as a good practice, let's just document any notes that we can. So this is as of 16.2. Okay. This cost of equity. All right. Okay. Now, this cost of equity and terminal growth. Okay. Now let's just, or before we do that, I just wanted to talk about something else. See, you may also want to add cash balance as of 2024 to this fair value of equity. Cash balance is, if you do that, I just added the cash balance as of my base year to this fair value of equity. So if I divide it by the number of shares, my value increases by around 250 rupees per share. But still, this still would be make it overvalued, because 3,800 is higher than 3,400. Okay, although the premium has reduced now slightly. Okay. All right. Now let's do sensitivity analysis real quick on this fair value of equity. Okay. So by sensitivity, our valuation, we have used these two parameters. Okay, and arriving at these two parameters is not an exact science. Okay, I know we have used point estimates, but in sensitivity analysis, what you do is you put a range on these two parameters, and then you come up with a range of fair value of equity. So the benefit of doing a sensitivity analysis, that is the ranging cost of equity and terminal growth, is you get a range of on fair value of equity, and you get to know key at what cost of equity, at what terminal growth you may be reasonably valued, you may be undervalued, you may even be undervalued. तो पता लग जाएगा कौन सी equity, cost of equity पे, कौन से terminal growth assumption पे आपका equity value undervalued है या overvalued है. Okay, so that's the benefit. So and I realize I'm using Google Sheets, and I realize Google Sheet doesn't have that sensitivity analysis wala feature like Excel has. So instead of me transporting everything in Excel and showing it over there, let me just show you कि sensitivity में करते क्या है. So if we increase the cost of equity, say by 11%, if we reduce the terminal growth, say to 4%, so we are basically increasing our discount rate, and we are lowering our terminal growth. Okay, so terminal growth from 4,000 has fallen to 3,600 something, from 5,000 CR to 3,600 something, and discounting has increased. So what happens is fair value of equity obviously would reduce क्योंकि आप discounting बढ़ा रहे हो. Okay, so premium, look at the premium. Premium has skyrocketed. Okay. All right. So that is when investors are expecting a higher return from this company. Okay. But say if you reduce your cost of equity to just say 10%, you increase the terminal growth to, let's say, 5%. So you're reducing your discounting, you're increasing the terminal value. Then obviously the fair value of equity has increased. And now the company, the equity value is trading close to being reasonably valued. So you get to know कि अगर आप cost of equity कम कर दोगे, which is like obvious, right? So at this cost of equity, at this terminal growth, your firm becomes close to reasonably valued. Okay, all right. So that's the benefit of sensitivity analysis, that it tells you at what cost of equity, at what terminal growth your firm could be, your equity could be overvalued, even overvalued, or perhaps massively undervalued. Okay, but for now, we are going ahead with this, with the cost of equity terminal growth that we have tabulated, that we had estimated. Okay, all right. So, guys, this completes our module. Okay, hope this was helpful. Okay, and so we completed module 7. Okay, now the next module is free cash flow. We'll estimate the value of this firm using free cash flow to the firm method. This is another method of valuation. And the interesting thing about this method is that we don't have to get into the problem or the jhanjat of estimating debt in the future. That's why a lot of people, they actually recommend this method, because you don't have to make any assumptions on debt. In fact, a lot of people, they say that if a firm has debt, if a company has debt, then use free cash flow to the firm. Okay. All right. All right. So next module would really be interesting, because then you would realize the difference between free cash flow to equity and free cash flow to the firm method of valuation. All right. So guys, hopefully this was helpful. And if you're really liking this content and if you're learning something, then please feel like and subscribe and share it with your friends, because this would be a major confidence booster and I would be encouraged to make more videos like this. Okay. All right. And next time I'll keep the content. I'll try to keep the content short. Okay. All right. Thank you.